Welcome to Mind Blowers. Today we have a fantastic episode for you, and it's all about how can you invest for AGI. So it's important to say this is not financial advice. We don't know your individual situation. But what we are going to talk about is which asset classes we believe will increase and which ones we believe will decrease.
Mind Blowers, uncovering the mysteries of the future. This episode, Invest for AGI, optimizing your portfolio for the future, with Lars Tvede and your host, Daniel Kafer.
So this show is divided into 4 parts. The first part is what we call the Great Disconnect. AI gurus are talking about double-digit growth and a revolution within AI and robotics that will change everything we know about the economy and the stock markets. On the other hand, we have the governments who forecast as business as usual, as there was no AI or robotics revolution. So we will look at, in the second part, how we believe that AI and robotics will actually impact the markets, the inflation, the GDP growth, and those factors. In the third part, we'll look at how we think stock markets will perform, how will bond markets perform, how will commodities perform, and how will different collectibles perform. Finally, I'll try to help you identify some actual ETFs that we will believe that will perform better than average and which ones you may want to stay away from.
Anyway, the purpose of this podcast is to talk about how you can invest in AI. And in preparation for this, we were looking at statistics, and then we were quite shocked about how different they were. So, just give me the background for what you saw, then I'll tell you what I saw.
So, on the one hand, we hear the AI gurus like Elon Musk, Sam Altman, Leopold Aschenbrenner. They are talking about a revolution. They are talking about how AI and robotics will make the world so effective that everybody could pretty much be out of a job and all goods will be abundant and virtually free. So that would, of course, mean a GDP that would skyrocket. It would probably mean negative inflation as goods become cheaper and cheaper. And with that, the interest rates would also be impacted, being quite a lot lower. But then we looked into how do the governments actually budget, the American government and the EU. And this is so interesting because they forecast absolute business as usual. So if you look at, for example, GDP growth, they forecast an average of 1.6% all the way up to 2060. They forecast that the inflation will be around 1.9%, and they forecast that interest rates will stay stable around 2.5%. So who are going to be correct when we look at this great disconnect?
So I have been looking at a lot of different predictions also over time. For instance, I saw one was about last year from Goldman Sachs where they said that unit labor productivity, which is not exactly the same as real GDP growth because you have population growth or population decline. But so unit labor productivity, the structural rate had been the last 10 years, 1.3% per year, which compounds over 10 years as something like 16% growth in the real economy. But then they expected that because of AI, the growth rate would more than double to 2.8%, which increases the compound growth rate to 32 or whatever percent. But I also saw something that I found really interesting, and that was Accenture, the huge consulting company. So they had done some studies of what was the likely consequence of AI on some specific sectors. And there they had been working at the micro level, going into the details of what would happen inside each of these sectors. And they have been thinking, well, it's quite radical what we see. And then they took a standard macroeconomic model and just had that to run predictions for the trend growth rate until 2030. And then they went in and adjusted in that model each of the sectors where they had done micro calculations. And then certainly the macro models spit up around twice as high numbers, very high growth numbers. So it seems there's something big there. And also I saw, for instance, a long-term chart for unit labor productivity in the US going back to 1960, I think it was. And it showed that it had been trending between 0.8% a year and 3.4%. Or 3.2%. So almost, at the high years, it was 4 times as big as the low years. But it was not like a random thing. It was trending. So it was trending for many, many years, up and up and up, and then peaked, and then it was trending down and down, and then throughout and went up again. So on the basis of this, I think it's kind of odd that you make a long-term prediction for the economy and completely ignore what we already know about technology. And what we already do know is that AI is going to roll out dramatically. It's already doing that, but it will roll out dramatically over the next few years. And then we'll also get robots. So, I mean, a couple of things that we can see in Supertrends, our forecasting company. We have about 4,000 predictions for the future. Many of them first found or made by AI, but then verified by 160 experts. And then when we look at what we have, we can see that agentic AI, where you take a lot of agents and also transformers, by the way, that you can find, for instance, on Hugging Face, where there are more than 1 million models available, and where it's growing very fast, maybe will be past 5 million a year from now. That's really beginning to kick in now and will become ultra big within the next few years. And then personal AI is around the corner. GPT 1.0, like new way of structuring AI, where you have a chain of thought and the scaffolding. So it's the things that work step by step and so on, which means that it can solve more complex tasks. Physical AI is anything from self-driven cars to, versatile robots, humanoid robots. That would probably really, really kick in around 2028 or so. So Elon Musk, who is not necessarily known to be pessimistic with time estimates, but he has predicted there will be more than 1 billion of these robots by 2040. Hard to say, but it seems like you can equip these, you can connect these robots to superhuman intelligence within 3 or 4 years from now. They can probably work for something like $2 an hour, 364 days a year, 24 hours a day. And agentic AI works for power. It works almost for free. So in a sense, it looks like we will carpet bomb the world with almost free academic work and extremely cheap physical work within the next 10 years. And to assume that the growth rate will be unimpacted by that sounds really strange. And we both know that baked into the predictions that are made by macroeconomic models is an assumption that there will be innovation. But innovation is not constant. There are some big waves. The internet was a big wave that drove up unit labor productivity massively, but gradually over a period of time. This seems to be poised to do the same, but in a much, much larger scale and sustained for a very long time. I would think that we are heading towards much higher, not completely insanely dramatically much higher trend growth, but much higher trend growth, at least than these models from the budget office in the US and the EU.
Yeah, it's interesting. I just saw an interview with Elon Musk, and he was actually debunking that he's optimistic in his predictions, because he's saying the media only reports when he's optimistic. They don't report when he actually underestimates.
I saw that, and then he talks about how quickly he rolls out builds factories and battery factories, car factories, also the new AI server park, where he beats his own estimates, right?
Exactly.
Yeah.
I just think a good way of looking at this, I actually think in the same interview he said that by 2040 there would be more than 10 billion robots. So I don't know if he actually confused 2040 with 2050 there. But even if it's just 1 billion robots, let's say most of them, for example, are in the US, it would mean almost doubling their population. And while, it's not everybody in a population that contributes to GDP, at least not very much, right? But every robot would probably contribute, especially powered by a super intelligence.
Yeah, there are some interesting data here because you and I have looked into that. And so the average human works 8%, or people like you and I, perhaps a bit more, but on average, people work 8% of their life. First, you're a baby, then you're a child, then you're in the school system, then you take another education, perhaps, and then maybe you join the labor force when you're 22, something like that on average. And then you're ill and you're on holiday, then there's a national holiday, and you sleep and you eat, and then you retire. So 8%. Robots and AI agents and AI models can work 100% of the time. But the second thing is that, now I said it, that you can make a human work, you can on average create a full-time workforce in human shape within 22 years. So how quickly can you build a robot in a factory? You can probably build a robot in a day when this really becomes mass production. And how much does it cost to create a human labor participant? Somewhere between maybe $150,000 in a developing country and $300,000 to $400,000 in wealthy society. But Elon Musk, he says he thinks that these robots will cost $20,000 to $30,000 each when they become mass market. As usual, the Chinese will probably have another idea. They already have one from Unitree that costs $16,000. So time will tell. But if in any case, if you amortize that and add the power consumption, which is not much more than $0.50 an hour or something like that, then they are massively competitive. So if you inject billions of AI agents, billions of physical robots, or it may be trillions of agents and billions of robots into the economy, it will have massive impact. And that leads, I think it also leads to some thoughts about other kinds of statistics that ignore, radical developments in technology. For instance, when I look at some of the predictions from International Energy Agency and the EU and others about the future, energy demand and energy supply and the mix of energy supply by source, many of them seem to ignore the radical innovation that is taking place within nuclear. Many think that nuclear will, even in 30, 40 years from now, have a very marginal role. But there's really, really radical innovation in nuclear. So if you look at what the big tech giant in the US and also the big entrepreneurs founding, running, and working in these companies talk about, many of them talk about nuclear fusion will be the dominant energy source in the second half of this century. But then these more classical institutions that make predictions completely ignore that. And then also another place where I see a disconnect between what happens in technology and what many economists talk about is that many economists are very concerned. Also, many politicians, at least until very recently, were very concerned about the future labor shortage because of super low fertility rates, and they try to do everything they can to have people get more children. However, then the people who are focused on technology, they're talking about exactly the opposite. They're talking about what on earth shall we do if robots and AI does everything? So these two things, they can't both be right. And I think the people who are concerned about declining birth rates, if they're concerned about it from a labor point of view, they're completely ignoring what's going on with technology. And they're also ignoring, although it's more speculative, but there is a lot going on in healthcare and anti-aging technologies, which indicate that the average health span, so the healthy lifespan where people can work, will begin to expand, and perhaps dramatically so, within the next 10 or 20 years. And that means that it could be that, newborns and young people now may have a life expectancy of 150 or 200 years. We don't know that, but we think it will start to creep up within the next years as all of these experimental technologies become real products.
Yeah, we actually heard Aubrey the Grey mentioning this, that he was, giving seminars to business leaders about the longevity effects that he believes will start to kick in like 15 years. But he said, they're all ignoring it. They're like, this is really interesting. We should take this into account. But when they go back to the spreadsheets, they don't make any adjustments.
Yeah, they have a model. They spend a long time making the model. They don't want to change anything in the model. It's really strange. Sometimes I think it's really strange.
So maybe we should talk a little bit about what we think. So I think, we are more optimistic than like the CBO and the in terms of growth, but we also think that like, for example, Kathy Wood from ARK Invest and especially Leopold Aschenbrenner is probably way too optimistic in what will actually happen. So would you say you land somewhere in the middle of the conservative 1.6% growth in the US and the more crazy predictions like 10+%?
It's very difficult to estimate. I would guess that we go up to a trend growth rate of 3 to 4%, something like that. But it is very difficult to estimate. The point of that is that will be at the very high end of the interval that we've seen since the 1960 or so. And it will take time. So AI, first of all, the AI, which is not physical, but the purely digital AI, has to spread out in society and permeate what almost every company does. And it just takes time to absorb it, but it will also get more and more user friendly. So we are also approaching a point where AI really autonomously codes AI, which is kind of singularity in itself, and where you can simply give you for some purposes, you can just say, create a website or a game or a piece of software, and then it does it. But you get to the point where you can give a very complex instruction and it's handled completely autonomously for you. And that will really speed up things. And the purely digital part comes first. And then within that, the GPT-001 is what you sometimes call a reasoner. So much more structural thinking. So when you have many reasoners, the next level is where these can work as autonomous scientists or engineers, and you can simply give them a purpose description, and then you don't have to tell them anything else. It's not like you give a task and get a response, but that you give it a job task and get a response, but you give a work responsibility, and then it will autonomously, in cooperation with other units, continue to create progress in that. So that will come before 2030. An incredible number of super amazing things will be widely implemented, and that will drive up the growth rate. So it could be that we see higher rates than these 3 or 4, but I think 3 or 4 sounds quite likely, and that compounds tremendously. And I can't help thinking about the situation in the US now, where they run 6.8% budget deficit, and they've just come out. They've just announced that Ravachani and Musk will be heading the commission to streamline, rationalize, and cost cut the public sector. And the most likely Treasury Secretary has this stated 3-3-3 principle, where he says he wants to bring budget deficit down to 3% of GDP. He wants to have a trend real growth rate of 3%. He wants to increase the oil production by 3 million barrels a day. So if you take the task of getting the budget down from 6.8 to 3%, takes 3.8% out of the GDP, out of the annual GDP growth. So if you only do that, then you get a depression or a recession, and they really, really want to avoid that. So right now the GDP is growing like 2.2% or so. So you want to get that up to 3%, so that's 0.8%. But then you also have to compensate for what you took out of the public sector, which is 3.8. So it's 4.6% growth in the private sector you need to produce at the very least, and that requires that you have you deregulate, you cut tax rates, but also that you roll out these new technologies quite quickly.
So looking at inflation and also interest rates, how do you think the impact is going to be, maybe both in the shorter and the longer term? I should mention that we're not trying to give financial advice to people here, because every situation is different. Also, we're looking at a strategic view, like the next 10, 12, 20 years, not like we're not trying to predict the coming year of stocks. But so looking ahead, like let's say 10 years, what do you expect to happen with inflation? Do you think they're correct that it will be around 2%, or do you think AI efficiencies and robotics will drive it down further?
Inflation is a complex matter because you have this consumer price index, which is representative of, the components of that are representative of the things that normal people buy. But for instance, I saw quite a few years ago, somebody introduced alternative inflation index for wealthy people, and it showed that what wealthy people buy had much higher inflation than what normal people buy. So I think that phenomenon will be accentuated here. So I think that many things will become free. So digital things like doing your tax returns or getting legal help for writing a contract and stuff like that will become completely normal to do it for free. Similar to a lot of other things we've already seen. For instance, today it's free to take pictures. When I was small, you actually had to go down to the shop and buy some film and put it into your camera. And then have it developed, so it was quite expensive then. So what I think will happen is, so these top-line consumer prices that are tracked will have persistent downward pressure because of these technologies. The central banks don't want them to go substantially below 2% for different good reasons, I think. So they will then produce more money to counteract that. And that excess money will go into things that are not scalable with the technology. So it will go into, premium real estate, commodities, collectibles, gold, Bitcoin, stuff like that. And we will already see that, but I think that phenomenon has legs. It will be persistent for a long time.
Yeah, so that sounds like inflation would be slightly or maybe substantially lower than the 2.5% when you sum up this together. Is that your view?
Yeah. So I basically divided into consumer price inflation and asset price inflation. And consumer price inflation will be very low. Asset price inflation might be quite high.
How do you think this will impact interest rates? I mean, looking at, for example, the 30-year treasury bond, do you think the value of it will start to increase and the interest will decline slowly?
So just as you have different parts of inflation, you also, of course, have different parts of the interest rates. So what the central banks are managing is money rates. So this is bank loan rates. They're not directly managing, unless they decide to do so, which is a rare occurrence. They're not directly managing, for instance, 10 or 30-year interest rates. But the two main drivers of these longer-term interest rates are, first, of course, inflation and expected inflation, and that's consumer price inflation. But then the second thing is the economic growth rate. So if the economic growth rate is high, then what you call a natural interest rate actually goes further up compared to the inflation rate. So for that reason, we can see that inflation is very low, but interest rates, longer term interest rates, are not becoming super low and not very high either, but maybe, in the US 4.5%, depending on how growth you have.
If we look at unemployment, so some people believe that robotics and AI will lead to unemployment. It's a quite complex discussion. I don't think we'll go into the details here. But if we follow a scenario where that holds true, that we will see more employment, do you then think that interest rates will be lower to kind of try to get more people get back in work?
Well, different central banks have different mandates. So the Fed in the US has a dual mandate. That means that they have to take both inflation and unemployment into account. And many other don't have a dual mandate. They only look at inflation, and then it's for government, so for fiscal policy to structural policy to take care of the other part. So if you'd see big social problems with big unemployment and no obvious solution to it, then that would be part of their consideration. But we also have to remember that now the US has a big debt. It's been built up in 3 waves. It was built up in 2008, 2009 financial crisis, and then obviously 2 waves, I would say. So the second big part in recent times has been, of course, during COVID. It's quite sensitive in order to manage this debt, they need to have reasonably low interest rates, and that's also a part of their long-term thinking. How can they get that?
Okay, so if we try to formulate this into more tangible advice for the listeners, it sounds like the growth should create an above average increase in stock indexes like the S&P 500. Are you equally bullish on the US and Europe and Asia, or do you think we'll see quite big differences in how the stock markets perform in these regions?
Well, because the Republicans got a sweep where Trump is the president, they got the Senate. As we speak, it's like almost 100% sure that they had the House. And they also got a 6-3 majority, you can say, in the Supreme Court. They have much more power to do what most people had expected. I think before the election, there was maybe among investors, people put 60% that Trump would win, but only maybe 20% or less probability that there would be a sweep, and now there's a sweep. So because of that, the Trump trade is really important. And I think the Trump trade involves, for as long as it lasts, that the US equities will do well. It could very well be that Russell 2000 will begin to outperform the more narrow indices. The Russell 2000 is an index of 2,000 medium-sized, even smaller companies. And they have, compared to bigger companies, lagged way, way, way behind. And certainly a possibility that they will outperform the other ones by maybe 100% over the next 10 years. I'm just guessing here, like one always does with financial markets. And one consideration about that is that when you talk about AI, everybody thinks about the huge mammoth companies that are doing the big models like GPT and Llama and Gemini and so on. And of course, NVIDIA, which has a quasi monopoly on making the relevant chips. But if we just take the production of these big LLMs, it certainly makes sense that they plow hundreds of millions or billions of dollars into that. However, these models right now don't have any network effect, and that means that there's no loyalty for users like you and me to any model. I mean, you use whatever is the best one now. So they are subject to price competition, they're subject to quality competitions, and there are websites that constantly rate them against each other on different standard tests. And this board of how well they perform is super volatile. So it's not so that they necessarily will make a ton of money on these models, at least not directly. Maybe indirectly they'll figure out a number of ways to do it. So if we take another situation where you put personal AI on a phone, let's say you do that on an iPhone, and so let's say I actually do have an iPhone. So you have an iPhone and you have personal AI on it, and it gets to know me really well. So it becomes more and more like a partner for me, becomes a coach, PA, personal assistant, and a lot of a motivator, a lot of things for me. Then I don't want to swap that out with another one, because then all the knowledge it has built up about me will be lost. But we don't have that yet. So so what I'm trying to say here is that I wouldn't consider the big LLMs necessarily as a big money spinner. I would think that the personal AI can be, and that because it's sticky. And then I think that companies all over the business scenery will have lots of possibilities of implementing agentic AI. So hundreds of thousands of small AI models that solve different tasks. But I also think some of them will be really good at doing that. A lot of them will miss the boat, because that happens all the time with all new technologies. It happened with the internet. It happened with allocation before that. It happened with steam engines before that. So there will be huge gaps where things, automatization and new products, solutions become possible in an industry where the legacy companies don't utilize that opportunity. And then you have these startup companies, which can be small groups or even single people, maybe 20, 18, 20, 25, 30, whatever year old, who see that, put together a swarm of agents and later also perhaps a swarm of robots to address this problem in a much smarter way. And then they go in and snatch a big part of the profit pool in a given industry. So it will be super volatile, but this will mean that I think parts of the venture industry will probably do much better than it has done lately, because it's been pretty much distressed for the last 4 years in particular, with very few exits. So that will improve. But if we think about established companies and also stock market listed companies, it would be important to really keep an eye on who are good at implementing this and who are kind of ignoring it, because the ones who are ignoring it will be in a really dangerous position. And then it's important to think about which products are desirable that you cannot really automate and make much, much cheaper with these technologies. So one product for sure is, we already talked a little bit about it, but premium real estate. So piece of land with a unique location, that's not made by AI or by robots. It was already there. But if the growth rate, and then for that reason, the compounding growth in wealth, so in income and in wealth, becomes substantially higher than we're used to, then such assets will increase at substantially higher rates than we have been used to. And I think that's very likely. And then you can think of which other assets meet those criteria. Bitcoin does, gold collectibles do, so including pieces of art and whatever. So what will perform particularly badly, are business models based on cheap human labor. And that's both, purely intellectual labor, but also physical labor, because that would be replaced at very, very low rates, if not in some cases for free. So those are considerations one has to have. And I think that this will also lead to the beginning of a new commodity cycle. So commodity markets, just like unit labor productivity, tend to move in very long cycles. So you can open more mines, but when you dig into it, you find out that, for instance, it takes on average about 15 years to open a new copper mine and to reopen an existing one, but there's only very limited possibility of that. It takes 3 or 4 years, but the new ones take about 15 years. And if you look at the projects that are in place, and I'm just taking copper as an example, if you look at the projects, the existing mines, what is expected to be produced by them, and the projects that have been announced to open new mines, if you add that up, the copper production will actually decline from now on. So it's not enough for an increase. So this is an example where you have a disconnect between what people expect. For instance, when people talk about, we'll deliver a ton of solar and wind power and electric cars, these things require an enormous amount of copper, and they require an enormous amount of other industrial metals as well, and the industry is not prepared for that. So I think that this is also something that where the prices can benefit from this economic growth effect that we'll get from AI, and plus, on top of it, in this case, from the energy transition that is underway right now. And we've seen an example of this because we have witnessed over the last 3 or 4 years a complete collapse in building activities, so real estate construction activity in China, which has gone down, as far as I can see, from a peak of around 33% of GDP to probably around 17% today. And so why don't they have an economic depression? And what happened to their copper consumption? So what they have done is they have shifted just a lot of economic focus, partly into this energy transition, building on incredible amounts of electric cars and so on. And then if you look at the copper consumption, instead of collapsing, it has continued to increase pretty much the same rate as it did before this property crash, because of solar, wind, and electric cars, and in particular because you have to upgrade the grid massively in order to handle these unstable energy sources. So that also speaks for the commodity bull market. And then our energy supply will also go up. And so my best estimate is, but it's not a super sophisticated estimate, but that is that, for instance, the US energy demand might double until 2050. So which means in the next 26 years. And so why is that? So first of all, I think everybody who is not living on a rock knows that data centers require quite a lot of power, but it's not so much that alone. So I think it's about 4% of the electricity consumption in the US is now going to data server parks. And there was a new McKinsey study that said that will probably rise to about 11% by 2030. And I think it's reasonable to extrapolate that could be 30% of global power consumption in 2050. But we have to just be aware that power is only 20% of all energy in the US. So what will happen with the rest of the energy demand, which it's got nothing to do with data servers. But if the economic growth rate becomes much more than it has been previously, then people want more of everything. They want more. They want bigger houses. They want bigger boats. They want more flights. They want more holidays. They want better everything. And that means that quite close correlation between economic growth and energy consumption. And so if I throw this into the calculation, I think it's not implausible that the US energy consumption will be twice as high in 2050 as it is now. It's a wild guess, I know that, but I think the direction is clear that energy consumption worldwide will accelerate. And then because solar and wind, in my opinion, it can contribute, but it can never really substitute fossil fuels. It will make a dent. But even people that I respect very much, who are much smarter than me, like Elon Musk and Ray Kurzweil, say things like, there's so much solar power and we will soon get to 100% solar. I think they ignored the metals issue when they say that. So I think that we will have a bull market in commodities and also in commodities relating to energy, and that includes for nuclear. So I think uranium is very interesting. So right now, the world economy has a deficit on uranium in the sense that we consume more uranium than we produce, which is possible because the inventories are dragged down. That cannot continue. So I think that we are heading towards a real squeeze there because it looks like there will be a real shortage of uranium. And maybe some people say, yeah, nobody builds any nuclear reactors, but that's not true at all. So China is building a lot of them right now, and they're talking about building 150. Denmark has had a huge majority against nuclear power until very recently. Now there's actually more people in Denmark who are pro-nuclear power than against it. The EU has just classified nuclear power as a green energy. We're still waiting for Germany to get there. So I think nuclear has to grow, and there would be nuclear fusion, but there will also be nuclear fission where you will be using uranium, and that is not priced into the market, I think.
How can people buy uranium? Do you simply buy an ETF that tracks the cost of the material?
Yeah, you can either track the material or you can track the mines, and I think it makes more sense to track the mines, but there are ETFs for that, yes. And there are ETFs to track industrial metals, but there are also ETFs to track the mines that operate in that business.
Yeah, so maybe it's worth to mention, right, that our core belief, at least mine, is that AI and robotics will not lift all boats, but it will lift many boats quite broadly. When we say boats, we mean sectors and stocks, right? So where what we are saying is not that people should try and stock pick in this situation, because it's really, really difficult. We're trying to highlight some broad changes where we believe that some commodities and some types of stocks might outperform other types. So I think it's quite important that people don't pick one single mine, for example, because the volatility is simply when you go into that kind of specific stock picking.
Yeah, and then I'd say something more on a tactical basis here, that the risk to the Trump trade, as I call it, is that interest rates go too high in the US. And that could happen if they cut taxes a lot and growth become really intense and you have real bottlenecks. So now they have announced that they want to cut public spending massively. So if they manage simultaneously to cut public spending and increase the growth rate in the private sector, then we have a dream scenario for investors. But if they fail at that, so interest rates, bond rate, 10-year bond rates, government bond rates go up to 5 or 6%, then the markets will not like that. And then we'll have a completely different picture.
Yes, but again, I mean, generally this advice is about what will do better than average over the next 10, 12 years, because I mean, it's impossible to predict what the market will be like in the next year. So I think it's pretty important to say that we're not necessarily predicting a bull market in the next 12 months, but we do predict an above average return for the next 12 to 20 years. I mean, I believe that's our main point. And also when we look at GDP growth, we don't expect it to jump next year. At least I don't expect it to jump next year, but I do expect that when we see some type of AI that resembles AGI more, whatever that may be, however you define that.
Yeah, but please try to define it for those who don't know.
Yeah, so for me, AGI is artificial intelligence that can do everything humans can do, at least in a work capacity. I'm not so interested in whether it's sentient or not. So I'm thinking about the software, like a large language model or a robot, where you can basically pick them to do almost any job. And I think even if you don't get to that, if you just get them to them being able to do, let's say, 80% of all jobs, it will still have a huge impact on the economy.
Yeah, so I would think that a little bit depending on how you define it, this artificial general intelligence will be available somewhere between 25 and including 25 and 28. So I think it's very close.
Yeah, exactly. And my core belief is the definition is not that important. It's not that important whether we say we have AGI or not, at least in my opinion, because I think people move the goalpost all the time. And I think there will still, in a couple of years, be jobs that cannot be done by AI and robotics. But does it really matter if that is 20% of all jobs and it can do 80%? The impact is still huge. So I think for me, it's a slightly academic discussion, but not the most important one.
Yeah. By the way, I think one thing we should just point out that in both inflation and in GDP, we see distortions by technology, because when things become free, they drop out of both calculations. So the cost of taking pictures with your mobile phone is not a part of GDP, and it's not about the inflation measure, because it's free. But it used to be a product, and as we talked about, this used to be fairly expensive, and then it was part of, I don't know if it was part of the inflation index, but it was certainly part of the GDP. And what we can see is that living standards rise massively over the next 10 or 20 years, but it will not be fully reflected either in GDP. So the GDP numbers that we see will not be as high as they really should be, and the inflation numbers we see are not really as low as they should be.
Yeah, I think it's a good point also, because I think we'll see real deflation when it comes to transportation. But then again, how will that be calculated? Let's say in 10 years, almost all vehicles will be autonomous and we'll have the robo-taxis taking care of a lot of transportation. That could actually mean a lower GDP, but a higher quality of transportation, right? So that does make it pretty complex. I also think like food production, for example, I think we will see tangible downward changes in those prices. As we discussed, real estate, that's a really complex one. So we'll both see, some prices going up and some going down. So
yeah, it could be that prices of quality land goes up, but the cost of building on it drops by 30% because of automation. It can also absurdly mean that the cost of unattractive land goes down, because more and more people can afford to move to where there is attractive land. And of course, then you get a bidding war for the land, but you also get better utilization of that land. So I live in Switzerland, and the Swiss Alps are very attractive. Lots of people want to have a place in the Swiss Alps, but there's a legal limits to how much you can build above ground. Many of the chalets in the expensive places have massive palaces underground to the swimming pools and amusement parks and whatnot underground, because there's less limits to that. So that kind of reflects a situation where people can afford to build a lot, but they cannot afford to buy a lot of land.
Yeah, so at the end of this video, I will try to go through different funds to kind of help people more in a more practical sense in terms of how they could invest. But I just wanted to talk a little bit about what not to do. So how to avoid the downside. So you said, be careful with countries or companies dependent on low salaries, because they will be replaced by robots. So what kind of stock indexes are you looking at there that could be dangerous to invest in?
I'm looking at emerging market stock indices in the more backwards markets that really depend on these things. So some of these emerging markets depend a lot of commodities, and I think that's fine. But the ones where it's really cheap labor and not backed by technology, then I would have a concern.
Okay, but most emerging market indexes, they're quite broad, right? I think with maybe like 60% on China, if I'm not wrong. So would you be cautious of those, or do you think they'll be fine?
Okay, so China is a complicated story. It's super complicated. So they have decided to stimulate enough to maintain their growth. If you compare them company for company as you take the Chinese tech companies, their typical valuation is about half of American comparables. So I think there's a tactical investment case for Chinese equities. However, I doubt that it really is a long-term opportunity. And the reason for that is that whereas they have had extremely high economic growth over a very, very long period, this has not been at all fully reflected in profit growth. And the reason for that is that they have a tendency to overinvest. And so let's say there's a market demand for something that will require 8 factories, and then these 8 factories can make a decent profit. If you make 6, they'll make a hell of a profit. But if you make 10 factories, they will all make a loss. So there's a consistent tendency, and we've seen this also to some degree in some other Asian markets, where when you do that, you get higher economic growth, but equity markets are sort of strangely underperforming over the long term. So that's a risk I see over the long term for Chinese equities. Right now, I think they look pretty good.
And how do you view, I mean, we talked about commodities, but there are many different commodities. So are there some commodities you would be very careful with?
Yeah, agricultural commodities, I think that's actually far more scalable than industrial commodities, so missiles. We've already seen persistently over many that very high productivity gains in commodity production. I think that will continue. Just as an example, if you compare the world situation today with how it was in around 1980, so during that period, we've seen the world population more than double. We've seen the average consumption of food increase by, I think, about 30% per capita. So it's well over a doubling of the consumption of food. Plus, we've started using quite a lot of the land for biofuels. But nevertheless, we have less farmland now than we did then. So what I would say is that what you call soft commodities, which is what is produced in farms mainly, I would be less structurally bullish because you have ongoing productivity gains in farming. I think they will accelerate actually because of AI driving genomics, and also because of some other technologies like vertical farming, precision fermentation, and so on. So I don't think there's a long-term strong bull case for that as there is for metals and for energy.
So here in the final part of the video, we're talking about how you can actually trade these different equities. So again, what's important to say is this is not financial advice. I'm simply telling you where I'm personally allocating more of my portfolio and where I'm allocating less. Also, in the description below, you'll find links to where you can trade these different equities. The link is to eToro. You can, of course, use any other investment platform, but eToro is pretty good. They have pretty low fees in general. Anyway, it's very important to say that this is not tactical advice. It is strategic advice, which means we're looking at an investment time horizon of 5+ years. So preferably something you're able to hold almost indefinitely, but at the very, very least 5 or more years. So we're not talking about tactical trades where something might go up in the time frame of 1 year, for example. So based on what we talked about, personally, I'm going to allocate less to emerging market stock indexes simply because they're quite reliant on low-cost labor. And when we look 10 years ahead, we believe that low-cost labor will be replaced by robotics and AI. So their advantage will be eroded. So that is why we think there's not so much strategic growth in these indexes. Also, for example, agricultural commodities, so anything that has to do with food, for example, or clothes, we also do not believe that they will grow that quickly. So here are a couple of examples. For example, the Vanguard Emerging Market Fund. I'm going to cut some of my investments there. We also have a look at China. So Lars mentioned that China might be a good strategic trade, but on the longer term, we don't see the companies actually earning a lot of profit. So we're not so bullish on China either. So I also have a couple of question marks where I may lower my investment slightly. So one of them would be the long treasury bonds. If we get very high growth, we could see high interest rates for long. On the other hand, if we see AI and robotics create unemployment and not quite as high growth, maybe we'll see very low interest rates. So we're a bit unsure about where we're going to see interest rates go. And then there's real estate. I'm not too bullish on real estate, at least not when it's not in prime locations. So I may lower my allocation in REITs across the world. So REITs are basically real estate funds. So where I'm going to increase my allocation would be to copper, where we see that there's going to be a long-term undersupply of copper that we believe will drive the price up. So there are two ways to invest in copper. Either you can invest directly in the commodity or you can invest in the mine. So I think both are a pretty good bet. In terms of stock allocation, we are mostly bullish on the US, as it seems Europe are lacking in the AI and robotics development. We do, however, think that stock prices, as a general rule, will rise because of AI and robotics. The Russell 2000 index looks like a pretty good bet as it has been lagging some of the other indexes, like, for example, the Nasdaq index and the S&P 500 as well. So Russell 2000 are some of the smaller companies where the agile ones that adapt to AI should see greater profits. But of course, there will also be companies that will not do so well as a result of AI. But all in all, we believe that the Russell 2000 will perform well over the next 10 years. And then further looking into commodities, we do think there's no way around nuclear power, both of course as nuclear fusion in the further out future, but right here now in nuclear fission. With more and more nuclear power plants in China and the sentiment changing in some European countries, Denmark being one example, it seems likely that the demand for uranium is going to increase. So again, here are two funds that you could consider buying if you believe the uranium price is going to go up. These are at least two funds that I have decided to invest in. So again, it's very important to say that this is about allocation. It's not about putting all eggs in your basket. It's about where I would place more of my funds and where I will decrease the allocation slightly. So I hope this has been useful for you. And again, you can find links and comments both to relevant literature and to the actual funds that I'm suggesting either to avoid or to buy. Thanks for watching.